Hi there, I'm Kavita Bhartake from Cherry Street Investments. Today I wanted to talk to you about the tax benefits of real estate investments. Now, we all know that real estate can produce excellent returns. By that I mean double-digit returns, which you can't really get in the stock market or other investments anymore. So, one of the ways real estate investments really goes over and beyond the returns that you see on paper is with the tax benefits. And I'll talk about a few things that real estate provides as far as tax benefits, and we will start with depreciation. That's the first one. Now, with every single family home, and if anyone has owned a single family home, you know that you can get depreciation on it. The way it works is depreciation works is that you are allowed to take the improvement value of the house. So for example, if you buy a house for 100 or 200,000, let's say, and the land value is 100,000, then the improvement value is the other 100,000, and now you can depreciate that amount over 27 and a half years as it's set in the regulations right now. So the reason we depreciate it is the real estate improvement itself is a depreciating asset, meaning that it's losing its value because things are getting older, things are getting less. I mean, they're not working as well, right? Your depreciation for your washer dryer or your appliance has it's a limited lifespan, so you have to reduce the value of that appliance over a period of time. So that's why you get to claim a depreciation, or what we call a paper loss in this case. The advantage of doing a lot of commercial investments is that you're able to take advantage of larger depreciations and also something called accelerated depreciation, which actually came into effect pretty recently in the Tax Cut and Jobs Act of, I believe, 2017. So what it means to you is that now, instead of taking that depreciation over 27 and a half years, for some kinds of properties where you can do something called cost segregation, again, that's another topic and altogether, and we are going to be having a webinar on cost segregation soon. So I highly recommend you attend that webinar to learn more about cost segregation. Now, coming back to depreciation, because depreciation in apartments and hotels and other investments can be accelerated right now, which means you get the first year, you get to take 100% of the depreciation. That gives us a huge loss on paper. And what does it mean to you? It means that for every $100,000, let's say you put it into an investment, you're able to get anywhere from 40 to 90% of it as a write-off, as a tax write-off or a paper loss. And what that means is, if let's say that income, that 100,000 is making, let's say 8% cash on cash returns, then that 8% is completely tax free now because you have a paper loss that you can claim. Also, what's amazing about depreciation is that if you're a qualified real estate professional, and you can look that up, it's a definition that you have to spend about 750 hours in real estate. Now, when you're married, either one of you, even if you're a qualified real estate professional, you're actually able to use the depreciation against the active income of the other spouse. So if, let's say, I was married to someone who had a W-2 job and they were making active income from that job and had a W-2, then I'm able to offset with my paper losses with the investments that we've made. Take that paper loss, which is generally considered a passive loss, but now I'm able to offset active income as long as one of us is a real estate professional. And that's how it can be very useful for married couples, especially. If you're single and you just have a W-2 income and you really can't be a real estate professional, unfortunately, you cannot take that paper loss against active income, but you can apply it to other passive income, let's say rental properties or any other source of passive income. So that's a big way in which real estate can really reduce your tax liabilities. The other thing you need to understand is that, let's talk about QREP. QREP, like I mentioned, is harder to get to if you have a W-2 job, which is actually paying you most of your income. But if you have a spouse who is a qualified, who's a real estate professional of some sort, like you don't have to necessarily be a realtor, and a lot of people are misguided about it. You could be a mortgage broker, you could be a real estate investor. So it's really easy if you're spending enough time in real estate to get that qualified real estate professional. And that can be a huge source of income, because now if you're, let's say, paying $60,000 in taxes, you could potentially offset and not pay any taxes at all by using depreciation from one of your investments, and that's huge. So something to think about, and I hope this was useful. I'm looking forward to seeing you on our webinars. We will have one soon on cost segregation and depreciation, and also another one where I will be inviting my own CPA to come in and talk about how real estate can really accelerate and benefit you in terms of growing your portfolio as well as saving on those taxes, because we all know that the money we don't give away to Uncle Sam is money we keep. So that's huge, and it really compounds over a period of time. I hope that was useful. Thanks so much for watching. Take care. Bye now.